Hello, everybody, and welcome to Open Interest. I'm Mike Coe. What interests you? Please let us know in the comments section below. Have a question? We'll try to answer it. Have a suggestion? We'll try to incorporate it. And please be sure to like, subscribe, and hit that notification bell. A few of you have left comments, so today I thought I would tackle a few of those. But before we get to that, the market did calm down a bit today. The S&P 500 and the Dow Jones Industrial Average both closed up about 0.2% from yesterday's close, while the Nasdaq 100 index was essentially unchanged. However, the bigger news hit after today's close. We're seeing a decent rally after hours as Facebook, Qualcomm, PayPal all announced earnings and all are trading higher. Now, in the case of Qualcomm and PayPal, only modestly so, I think, within their respective implied moves, which were, I think, 8 and 12%-ish. But Facebook, which had been implying a 13.5% move post-earnings, has really spiked. In one shot, it has recovered all the ground it lost over the past week. It's up more than 20% from the intraday low of about 169. So earlier today, I put on a bullish call spread risk reversal in PayPal. And just to refresh everybody's memory, that's when you buy an at or just out of the money call, and you help finance that purchase by selling an out of the money put to the downside and an out of the money further upside call. Now, I don't have a position in either Qualcomm or Facebook. In the case of Qualcomm, I was a little hesitant because after hearing Apple and Taiwan Semi, within the course of the last several weeks suggesting a slowdown, and with Apple as Qualcomm's single largest source of revenues, nearly a quarter, I wasn't anticipating good news. And in the case of Facebook, this is a situation where I definitely recognize how cheap the stock had gotten. It's just that I don't happen to have the most favorable opinion of the company generally. Dan Nathan, Guy Adami, and I discussed all three of these stocks on their show, Market Call, which I encourage you to check out because they're putting that content out intraday. I should also point out, in fairness to my colleagues in our registered investment advisory business, that those investment strategies don't factor whether I personally happen to like what a company's business is. So that doesn't go into our investment calculus. In any case, all three of these names were great setups for short-dated call spread risk reversals into earnings. That's a strategy I particularly like in market conditions like these for two reasons. One of those is that many of these stocks had already fallen quite sharply, and sentiment was negative going into the print. In Facebook's particularly so. We could see that intraday. And in fact, actually, there was a moment when there was some data that was released that suggested very poor guidance, and the stock traded off, $8-9, I think, very quickly. And when you have these really low hurdles or expectations, it's a nice setup for a pop. Also, when you have this extreme negative sentiment after a sharp sell-off, implied volatility, the price of options, is generally going to be much higher. And what that does is it spreads out the strikes of the short put and the short call that you need to sell to help finance that at the money call. And so when you do that, it creates a bigger downside buffer. So if you own the stock and you're short a downside put, the risk, of course, is that the stock declines to or through that put, through it really, and then you could have the stock put to you at that strike price, be forced to buy it essentially. When implied volatility is higher, when you start seeing a lot of put skew, those downside puts get expensive. So you can sell one that is further and further out of the money and still give yourself some participation to the upside. Also, in those high implied volatility situations, the upside calls will also see a bid. So you get a bigger buffer to the downside and you get bigger participation to the upside. So this is a structure that really sets up well into catalysts such as these. So after that, let's take a look at a couple comments. The first one comes from Don Kelly, and he asks, why are equity values and bond yields both declining? Okay, so no question, equity values have definitely slumped. As of the close today, I think from the peak, the Nasdaq was down nearly 21.5%, so that's actually by definition a bear market. I think what he's alluding to here is the fact that yesterday and the day prior, maybe the 10-year yields came in just a little bit, but they merely dipped, and it was only very, very slight. You will sometimes see that in situations like this because of a flight to safety. So really the risk-free yields, U.S. Treasury yields, I think it would be more accurate to characterize them as having traded sideways. They barely came in. Now, if we start taking a look at how bonds performed more generally, so corporates, for example, those still are at or very close to their lows. And if you're looking for ETFs that track them, you can look at LQD as a proxy for the investment grade bonds, and HYG or HYLB as a proxy for high yield. Now, both LQD and HYG, as I just pointed out, are at or near the lows. And while I haven't spoken about either of these two ETFs for quite a few days after boring everybody to tears, mentioning them almost every day since the Olympics, the picture here still remains pretty grim. LQD options volume was actually unexceptional today, but there's two things that you ought to know about LQD when you take a look at it. The first is it's high duration. What that means is that the constituents, there's a lot of long-dated paper in there. And the longer duration suggests that, well, it doesn't suggest, it means you have greater sensitivity to changes in interest rates. If you have a long duration portfolio, that price is going to drop more when interest rates rise than if you have a shorter duration portfolio. So in general, there's two things you want to think about. Do you think 10s and 30s are capped at 3%? Then maybe you happen to also believe that most of the damage in here is done. I suspect rates pause here as folks digest the equity sell-off and the recession fears, but ultimately I think they're going to resume an upward trend. So moving from LQD to HYG, it traded about 450,000 puts, so definitely one of the busiest ETFs there was today. And I think much of that was profit taking. We saw that there was a lot of open interest on a lot of the strikes that traded heavily, but we did see some opening activity in the July 77s. I think over 10,000 of those trading for just over $1.70 a contract. And to put things in perspective, that brings the pandemic lows into frame. And in general for HYG, these are levels that have otherwise been unseen for a decade. So, market weakness, if you see rates stabilize, it's more of a short-term flight to safety. I don't necessarily think that rates are actually going to go materially lower from here. In fact, by the end of the year, I'd be surprised if they aren't higher. Okay, our next question comes from Pete Johnston. During this bear market, I have been looking for opportunities to sell QQQ at the money short-term call credit spreads, where the premium I collect is 50% of the spread. I only risk about 0.5% of my portfolio value in these trades, so the mitigation is small, but is better than nothing. It has been working for me so far in that I buy it back for a profit or let it expire. But I was wondering if you could comment on this type of strategy in this type of market. Thanks as always. Okay, so just to distill this question, I think it's asking, is it advisable to sell call credit spreads, that is to say upside call spreads, during a correction or a bear market? And as a reminder, a correction is when the market drops 10% or greater peak to trough, and a bear market is a 20% or greater peak to trough decline. And that's obviously what we've seen in the NASDAQ, and the QQQ is the NASDAQ in essence. So here's the thing. Generally speaking, when markets decline, volatility rises. And when volatility rises, that means that it's going to move more sharply both up and down. Since I was looking for the longest possible history to sort of see how equity markets behave when you have these kinds of drawdowns, I was earlier today just taking a look at the performance of the Dow Jones Industrial Average dating back to about 1900. And so here are just some statistics that you can use for your consideration. The average 30-day return over any period is about 82 basis points. And the average 30-day return on days where the 30-day peak to trough prior was down 10% or worse, so that's where the market had already recently declined sharply, the 30-day return on average was 1.29%. All right, so 1.29% average return over 30 days versus 82 basis points. That's a pretty material difference. So what's going on here? if you've already had a sharp sell-off, the chances that you get a sort of a throwback rally is increased, and you're just in a higher volatility environment. So when you're selling call spreads, it's something to think about. Now, there's something else I think that's worth thinking about as well, and this is really a little bit more specific to what you're suggesting you were doing, which is selling call spreads where you're collecting 50% of the distance between the strikes. So if you have a $10 call spread, that means you're collecting $5. In order to achieve that, the call spreads you're selling have to be pretty close to at the money. So just looking at the Qs, for example, I think we're just over 316. So you'd be selling maybe the 316 calls or the 317 calls. Now, you didn't say exactly how much time you have to expiration. You indicated it was short dated. But I think we have a chart on this. And what I was looking at was, okay, what is the likelihood that you sell in any market, that you sell a call credit spread and the short call that you sell is in the money at expiration? So over any 30-day period, the chances that the equity markets are higher is about 60%. So what that means is if you sell an at-the-money call, it's about a 60% chance that that call is going to be in the money at expiration. And you might actually collect slightly better than half of the distance between the strikes for a call spread like that. I was looking at the one, I think, in this example that we have right here, which is 316, 326, maybe $5.50, maybe $5.80. So you are collecting a little bit better than half, but still, you have to contend with the fact that the call you're selling is going to end up in the money more likely than not. Okay, here's an interesting thing. That is that if you push the short strike up just 2.5% from the at-the-money one, which I think in this case would be about 323, 324. So we have an example of that one too. The probability that your short strike is in the money falls to less than 40%. So we sell an at-the-money call credit spread, 60% chance your short strike is in the money at expiration. Use a 2.5% out of the money call that expires in 30 days, and that drops to a 60% chance that it's not in the money. And it's not simply an issue of how much premium you collect relative to that probability. It's also an operational issue, which is that when you are short call options that are in the money, there's a better chance that somehow there's an oversight. You don't think about it. You get assigned at expiration. You will never be assigned on out-of-the-money options. So if you ever have a situation where you are short calls and it's optimal to exercise them early, this is rare, but it does happen, that your short calls that it's optimal to exercise early because of, say, an upcoming dividend, you just increase that risk. So I think if I was going to look at strategies like selling call credit spreads, I might think about just going a little bit further out of the money, improving my odds, reducing the premium that I'm going to collect. The 324, 334 call spread, I think that the amount of premium you collect there is about $4.50 on a $10 wide spread. So that's definitely a way I might consider altering the strategy somewhat. There's another point that I wanted to address that you made, two of them really. The first is that you're sizing it to 0.5% of your portfolio. So first of all, for everybody, when you're thinking about options trades, this is really an important consideration, which is how much risk relative to your overall portfolio are you taking on any given options position. 0.5%, I have to say, is actually quite small. In many cases, because here's another way to think about it. So that's 1/200th of your portfolio. I don't know how many positions you maintain in your portfolio, but 0.5% is probably on the smaller end of what I would contemplate. Any smaller than that, and it's probably not going to have a really material impact on your performance. So you might upsize that just a little bit. And the final thing, which you also address, which is that you will sometimes take profits, sometimes just let them expire. If I am short options and they get very cheap, my general habit is to close them. I don't typically carry them all the way to expiration. I just don't want to look at a short options position that's only worth a couple of cents. So there's two implications to this. The first is I just think it's a good risk management strategy. You can free up capital to do other things. You just don't have to think or worry about it. There is another consideration too, though, and that is that when we think about the risk reward, let's say you sell a credit spread for 40% of the distance between the strikes. The chances that you're going to ride that to zero are pretty slim usually. Chances are you're going to roll it or adjust it or close it, take profits before it gets all the way to zero. So it's not really, the max reward isn't really 40% if you're collecting 40 or 50 in your case. It's a slightly smaller number. It's just a consideration I want people to have. But the flip side of that is that the max risk is also probably not the total distance between the strikes either. Why is that? Because if I have a credit spread on and it goes against me, I usually don't wait all the way to expiration either. And it won't go to 100% of its value in that case. So I don't ride it all the way to zero, and I don't ride it if it's against me all the way to 100. And that's because time goes from being on your side. If you have a credit spread on and it's out of the money, time's on your side. Every day goes by, you're getting paid a little bit. But if it goes all the way in the money, the opposite is now true. That's functionally a debit spread. It's going to increasingly go towards its maximum value. And that goes counter to everything that you're trying to do with the credit spread to begin with. So that's something important to think about as well. And finally, I think we had one other question, which I'm not going to address today, but I am going to address in tomorrow's video. I think it's a great question, and it just deserves a little bit more time and attention, and probably some charts, things like that, which I'm looking forward to including. And that one comes from Dr. Kent Daniels, who sent me a tweet at Michael_Co, by the way, if you want to send us questions that way. It's easier if you put them in the comments, but you can send me a Twitter question as well. Great open interest video you did on collars yesterday. Great job explaining how they work. Could you do a video on implied volatility and implied volatility rank and explain the differences, which type you use, and why? Okay. I've heard some options educators who talk about implied volatility and talk about options being a good sale or a good purchase, talking about implied volatility rank and percentages and things like that quite a lot. It's not that these are not at all valuable tools, that they have some utility. But I think a lot gets missed. That's why it deserves its own video. I hope you all are going to tune in for that one when I do it. I'm Mike Coe. Thank you very much for watching. If you like this kind of content, like, subscribe, hit the notification bell, and tune in for the next one. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Co, or go to our website, www.openinterest.pro. Thanks for watching.